Let's start with an example of how SMAs can be distorted by spikes in the market. So let's say we plot a 5-period SMA on a daily chart. The closing prices for the last 5 days are as follows. Day 1 is 1.2263, day 2, 1.2322, day 3, 1.2255, day 4, 1.2277, and day 5, 1.2384. So to calculate the simple moving average, it'd be really simple. You can see right below, you just add up those 5 numbers, the closing price for each day, and then you divide it by 5 since we have 5 different closing prices, and that gives us 1.2300 as the SMA. Pretty simple, right? And this makes it look like the market is going up. Now, let me show you an example of just one little change. Let's say all the numbers are the same, but on day 2, instead of 1.2322, we now have on day 2 1.2000, which is not a huge difference, but it makes a dramatic difference. We add those 5 numbers together below it to find the 5 SMA, and then we divide it by the 5, and we get 1.2235. Now, this would make it actually look like the market is going down, when in reality, the market is actually going up. But that day 2, that kind of spike in the market, caused the simple moving average to make it look like the market is actually going down. The point I'm trying to make is that sometimes the simple moving average might be too simple. But like I said, the good news is there's a way to filter out these spikes in the market, and that's through exponential moving average. Exponential moving averages, or EMA, give more weight to the most recent periods. In this example, the EMA would put more weight on the prices of the most recent days, which would be days 3, 4, and 5, which means that that spike on day 2 would be of lesser value and wouldn't have as big of an effect on the moving average. And if you think about it, this makes a lot of sense, because what this does is it puts more emphasis on what traders are doing recently, and that's what we care more about. So now I want to look at the difference between exponential moving average and a simple moving average. So you can see in this image, we put a simple moving average and an exponential moving average side by side. The exponential moving average is the red line, and it's closer to the price, which means it's more accurate. This is because exponential moving average places more emphasis on the most current prices and what is currently happening. This data of what's currently happening is way more important than data of what traders were doing, let's say, a month ago. So let's dive deeper into the differences between simple and exponential moving averages in these next sections.
Hey, thanks so much for watching. Make sure you join our free Discord channel to get access to all the cheat sheets and a bunch of other cool bonuses. The next video in the course is right here.